My name is Steve Looney. I'm chair of the tax department here at Dean Mead. And again, I'm very appreciative of you all coming out on such a cold and early morning for a speech. And I got to thinking about how do we get such a good turnout? And I first started thinking, well, it's not the lovable nature of attorneys, although we are really good guys, but you know, that's generally not our reputation. Then I thought, well, when I saw these facilities, I said, yeah, well, maybe it's the facilities and the breakfast, and I think that's part of it. But most of all, I think it's the subject. I mean, I know you all feel the same thoughts that we have about tax law. It's just so interesting and sexy of a topic. That's what brought you out here this morning. And when I thought about that, it kind of reminded me of a scene in a movie, which we're going to go to here, that kind of demonstrates, and it's kind of applicable because it deals with, it's actually a disaster movie, end of the world type movie. Don't associate that with taxes, but probably a lot of people do. But in any event, it's cold, and I'll just kind of let it play out, and it demonstrates how most people feel about taxes and tax law. That didn't work. Go back. Okay, there we go. All right.
Here it is. This fireplace probably hasn't been used in about 100 years.
All right.
What are you doing?
What do you think we were gonna burn?
You can't burn books.
No, absolutely not. You want to freeze to death? Friedrich Nietzsche. We cannot burn Friedrich Nietzsche. He was the most important thinker of the 19th century.
Oh, please. Nietzsche was a chauvinist pig who was in love with his sister.
He was not a chauvinist pig.
But he was in love with his sister.
Excuse me, you guys? Yeah, there's a whole section on tax law down here that we can burn.
Okay, maybe not the most sexy topic, but very important today, especially with the Tax Act. For the first 2 hours, we're going to be going over the income tax changes, and then we're going to have a little break. And I guess some of you will stay, maybe more people will come, and the last hour will deal with the changes to estate planning. I'm going to go ahead and introduce our speakers, starting on my far right, Charlie Edgerton, the senior member in knowledge, not necessarily age, of our group. Chris D'Amico, next to him, will be speaking. Ed Waters to give us a little youth. And to my left is Jane Callahan, who will be starting off by talking about the individual changes. But before I hand it off to Charlie, and Charlie, he's got a good perspective. He's a former chair of the ABA tax section. He's going to give us a little background of this whole tax act. And I know we've been hearing for the last 15 to 20 years about a new tax act. Well, this is the big one, basically. And the three pillars I always heard about the tax act are simplicity, fairness, and revenue neutrality. Well, I have to tell you, on the simplicity part and the revenue neutrality, the bill fails miserably, obviously. It has about $1.5 million of debt, and when I start talking about the deduction for pass-through entities for the qualified business interest, you'll see just how complex the provisions are. Fairness, well, it depends who you are, and we'll let you listen through it. Charlie, take it away with the background.
Thanks, Steve. I'm happy to see so many folks here at 8 o'clock in the morning, or 8:20, I guess it is now. It's amazing what free breakfast and an exciting topic like tax changes will do to bring people together. We thought it might be helpful to kind of go back and revisit how we got here. And I think the last tax change we had of significance was 1986, a little over 30 years ago. And the dynamics with respect to that particular tax act are diametrically opposed to what we had that we just went through. But there are some similarities. Going back to 1986, because I think it's good to contrast these, we had, first of all, a bipartisan effort to reform the code. It was kind of kicked off by Senator Bill Bradley, the former basketball player at Princeton and the NBA, and he took it upon himself to really stoke the fires for tax reform. He was joined sometime later by Jack Kemp, the congressman from the House Ways and Means Committee. Together they kind of got things going, and then the baton was tossed over to the leadership in Congress and to the president. And we had some interesting characters who were involved in that process. We had, of course, President Reagan, the affable and very popular president. We had the Speaker of the House, a crusty old guy from Massachusetts, Tip O'Neill. We had Chairman Rostenkowski, Democrat in the House Ways and Means Committee. We had the Senate, which was dominated by the Republicans at that time, or controlled at that time. We had Bob Packwood. And anyway, it was a process because the control of Congress was divided. And we had a Republican in the White House. It had to be bipartisan, and the process took about 2.5 years. There's a wonderful book. If you can think that taxes are interesting, it was called Showdown at Gucci Gulch, written by 2 Wall Street Journal reporters, and it's fascinating. It really is good reading, if you can believe that. But all the political dynamics that went on that led to this act. But what happened in that Tax Reform Act is that we had a major restructuring. In fact, they renamed the code, the Internal Revenue Code of 1986. On the individual side, we had a significant broadening of the tax base. We got rid of a lot of tax expenditures. We had one level rate that was the maximum rate, not one level rate, but of 28%. And that applied not only to ordinary income, it also applied to capital gains. And one of the problems of that particular time, the marketing of tax shelters to individuals was rampant. I can't tell, I think at one point I had well over 100 cases docketed in tax court from some of our very best friends who had pursued their lifelong desire to own a Charolais cattle herd, or to get into rental equipment, all of which was heavily leveraged with non-recourse debt, and it was throwing out tax losses, and they were quite incensed that the IRS would challenge that. Well, the 1986 Act absolutely clamped that down. It got rid of the tax shelters. And on the corporate side, it dropped the rate to 35%, dropped to 35%. It was well in the 40s before that. And it repealed the so-called general utilities doctrine, which C corporations, the biggest problem with them, as you'll hear, and it's still a problem, is double taxation. There were lots of ways out under the 1954 code. Most of those were pretty well shut down. And it really did simplify the tax law. So much so that I will tell you that a lot of what I did all of a sudden disappeared. And the membership in the American Bar Association tax section over the 2 years that followed the passage of that act dropped by almost 25%. And if you're looking for the hallmark of a well-designed tax reform, it's putting, frankly, us folks out of business. Now, I'm not particularly worried, and we certainly haven't achieved that in this latest tax act, but there really was a simplification. All right, let's fast forward now. Most of you, your impression of this tax act, and it's probably pretty accurate, is that we started off in the Trump administration. They went for repeal and replace of Obamacare. When that didn't work, they pivoted immediately to tax reform. And that was, I felt, kind of jumping from the frying pan into the fire. But in any event, and the president asked that they have a bill passed by the end of 2017. And this was a fast-paced process. But the process really didn't start there. Let's put this in perspective. The process really kicked off in 2010. You may remember President Obama had appointed Simpson and Bowles to head up a fiscal task force to try to deal with the economic problems. We were just coming out of the Great Recession. And one of the things they singled out for immediate attention was to totally redo the tax code. The 1986 Act, it served its purpose, but the economy was much different today than then. All of our trading partners in the industrialized world had dropped their tax rates for corporations, some of them as low as Ireland, 12%. We were sitting there with 35%. We taxed worldwide income. In the United States, they used a territorial system. Our U.S.-based multinational companies were at a tremendous disadvantage. I had one of the brightest guys I have ever known in my life was a classmate of mine at Emory. His name was Michael Gratz. He's now a professor of tax law at Columbia. He was at Yale before that. And he was the number 2 man with Treasury back in the first Bush administration. But he gave a talk on the need for tax reform, and he said, I'll tell you, if I had a student who was advising a client on where to incorporate, where to create and set up a new business that was going to operate on a global basis, if he said the United States, I'd flunk him on the spot. I mean, basically, things had gotten that bad. It had to be taken care of. President Obama even said that he would support a major overhaul, a dropping of the corporate rates to perhaps 25 to 28% under certain circumstances. And there was a bipartisan effort, it really was, in the House Ways and Means Committee, chaired by Dave Camp, for the most part at that time. And the Senate was controlled by the Democrats, but Max Baucus, who was the chairman of the Finance Committee, and his counterpart in the Republicans, Grassley, everybody was working together. They agreed we needed to have a major transformation of the code. And the question is how to do it. And they did a lot of working papers. Dave Camp, when he finally retired from Congress, did a complete markup of a bill just for a discussion draft that people could work off of. So it was a bipartisan effort. When we got to 2017, however, because of the acceleration of the schedule, the fact that nobody likes to do tax changes in an election year, and 2018 was going to be an election year, and the uncertainties as to, generally the party in power is going to lose seats, whether the Republicans would control either the House or the Senate after the 2018 elections. So the president put things in high gear. And I think most of the leaders in Congress and working in the tax area would have preferred to do this on a bipartisan basis, but unfortunately that didn't work out. And what we have is a completely Republican bill, but it was built on a lot of the work that was done leading up to it. So to say it is not, the Democrats certainly would not say it was bipartisan, and they would be right, but a lot of the provisions that made it into the code that we just found out about were developed on a bipartisan basis ahead of time. So that's where we sit. Did it achieve simplicity? Well, in some respects it did. It certainly did, I think, in the C corporation area. And the fact that we now have a doubling of the standard deduction, which is going to take a lot of folks out of itemization, and that is going to be a simplification process. But I'll leave it up to you after you listen to the presentation today whether we've achieved simplification and have we achieved fairness. So I guess I'll stop at that point. And Jane, you want to take it over and cover the individual changes?
Yes, thank you. So I'm going to start us off this morning talking about the specific changes that will primarily affect individuals. Starting with rates are lower. So in 2017, the highest marginal rate was at 39.6%. Now we're at 37%. And the new thresholds for the top marginal rates have also increased to benefit the taxpayers in those categories up to $500,000, up from about the low 400s for single and head of household, and up to $600,000 from $470,000 for married filing joint. Most taxpayers will see lower rates, but some will see higher marginal rates. So you'll see for singles and head of household hitting in around the $200,000 range, they'll actually be at higher rates under the new tax law. I do want to note, too, since I mentioned the head of household rates, that there is a new provision in the law that requires some due diligence for determining head of household status for tax return preparers. So just a comment for tax return preparers. Capital gains rates are unchanged. The kiddie tax remains in the code, but it is simplified. It was quite a difficult calculation before, basing it off the parents' rates, etc. Now for kiddie tax, the tax rates that are applicable to trusts and estates will apply to the child's unearned income. The individual AMT remains in the code. However, the exemption and exemption phase-out amounts are increased, meaning fewer people will be subject to the alternative minimum tax. The big one, the standard deduction, has been roughly doubled to $24,000 for married filing joint, $18,000 head of household, and $12,000 for all others. Again, basically doubled, which obviously means we'll have fewer itemizers. That has some impacts in the charitable area that I'll talk about later. And in connection with doubling the standard deduction, the personal exemption has been eliminated. So that would be one of the simplification pieces that Charlie mentioned. Deductions. The home mortgage interest deduction will now be limited to $750,000 instead of $1 million of acquisition indebtedness. This is for debt. There's a grandfathering, though, for the old rule for $1 million if it was incurred before December 15th, 2017. So that amount will be grandfathered in. It remains available for second homes. And the definition of acquisition indebtedness has not changed. It's debt incurred in acquiring, constructing, or substantially improving a qualified residence. But it's important to take a look at that now because home equity debt is no longer deductible. And that would be debt secured by the residence that does not meet that definition of acquisition indebtedness. And with that change, the taxpayers will need to determine how much of their debt is acquisition indebtedness. The state and local tax deduction is now going to be, the deduction will be capped at $10,000, and that's the aggregate of the state and local real property taxes and the income taxes or state and local sales taxes on the return. Note that this limitation does not apply to trade or businesses or activities for the production of income. This is a giant issue in high income tax states, which fortunately we're not in one of those states. But at the end of 2017, those states had many taxpayers trying to prepay their 2018 property taxes and other taxes to the extent that they could to try to take a deduction in 2017 before the cap is effective in 2018. The IRS came out with saying that the only deductible items would be for those taxes that were actually assessed in 2017. So for a lot of the people that prepaid, at least the IRS view will be that they're not deductible for 2017 if in the state where they were living, those were not actually assessed in 2017. Some of these states are also, again, it's a very big issue for high income taxpayers in states with an income tax. And some of these states have been floating an idea to work around the issue by allowing the taxpayers to make a charitable contribution to the state. So a contribution for the roads, et cetera, or whatever in the state, and take a charitable contribution deduction to work around that $10,000 limit. And actually, the Treasury Department has said at this point that they're tracking it and watching it to see what states are doing, but at this time they haven't completely rejected the idea of this charitable contribution workaround of this deduction limit. Miscellaneous itemized deductions are eliminated. In your materials, there's quite a lengthy list of some examples of those that are now been eliminated. I just put a couple here. Home office deduction, license fees. Those are no longer deductible at all. The medical expense deduction will be deductible to the extent that they exceed 7.5% of AGI in 2017 and 2018, and then to the extent they exceed 10% of AGI. Charitable casualty and theft losses will only be deductible if they're attributable to a federally declared disaster, like our recent hurricanes, the California mudslides. Moving expenses have been eliminated as a deduction except for certain military personnel. Charitable contributions remain in the code. Remember, though, that the increase in the standard deduction will impact whether taxpayers will itemize. However, the charitable contribution deduction does remain in the code, and one change, though, is that the old 50% AGI limit for cash contributions to public charities has been increased to 60% of AGI, so allowing some additional deduction for those cash contributions. And also the college sports seating rights deduction has been eliminated. So in prior law, if you paid $2,000 to your favorite university in order to buy football tickets, you were able to deduct 80% of that $2,000 contribution, and now that's eliminated. No deduction will be permitted. The limitation on itemized deductions for higher income taxpayers has been eliminated. So under prior law, as your income increased, you got to a point where your itemized deductions started to phase out. They will no longer phase out for the higher income taxpayers. Gambling losses and expenses are limited to winnings. That's a change. And then alimony will no longer be deductible beginning in 2019. It appears to me that for agreements that are entered into after the new law is in effect, taxpayers will simply change the way that they agree to make payments in a divorce, and they'll end up basically in the same economic position that they would be in now. So right now, I think that a lot of those cases are tax affected anyway. So knowing that alimony was deductible to the payer and includable to the payee, the taxpayers just arranged their situation to come out in the economic position that they wanted to come out in. So I don't see a big economic change anyway. Child and family credits.
You leave that if someone has an existing marital settlement agreement that was in place prior to December 31, 2018, the old law, and if it provided that the alimony would be deductible and so forth, set up under the old law, those will still be honored. It's only for the newly entered into marital settlement agreements. I believe that's correct, isn't it?
Thanks, Charlie. Yeah. Child credit has been increased from $1,000 to $2,000 per child. $1,400 of that is deductible. The phase out starts at higher levels, AGI over $400,000 for married filing joint and $200,000 for all others. And there's also a new credit for a dependent that's not a child, a $500 credit. And these changes were important to include in the new law so that some of the mid-income taxpayers would not see an increase in their tax liability. The Affordable Care Act, the shared responsibility payment, is zero beginning in 2019, and this change in the law is not set to sunset. And this actually, this provision is slated as a revenue raiser to raise about $300 billion because without the shared responsibility payment, less people will buy health insurance and less people will be claiming the credits on their tax returns for the health insurance, and then that turned out to be a revenue raiser. There's a few other individual changes in your materials, but now let's look at changes that affect businesses. I just wanted to give a quick overview of all those individual changes.
Okay, thank you very much, Jane. Okay, that's good. I'm there. We are going to shift gears and talk about business changes and looking out in the audience, a lot of familiar faces. Most of you are either business owners or folks who advise business owners. And as all of you probably know, we had a House bill for the Tax Act, and then we had a Senate bill which differed in a number of respects. And what happens, the process that you go through is then after those two bills are passed, the act goes to what they call the conference committee. And the Senate and the House of Representatives work out a compromise bill. And I just so happen to have an exclusive, it was leaked to me, clip of some of the early negotiations in the conference committee. And I'm going to go ahead and play that. And Jane, you probably just hit that. Oops, no, go back again. All right. Yeah, there you go. And this is it. This is how the sausage is made.
They've made a few requests, though.
Such as?
It's a few things here. Nothing really big. Just, well, as an example, Oscar here has got some outstanding parking tickets. Wants them wiped off his record.
56 tickets in 7 states.
I'll tell him, Oscar. I got it.
Okay.
Noonan's got 2 women friends that he'd like to see made American citizens, no questions asked. Max would like you to bring back 8-track tapes. Not sure if that's going to work, but let's see what else. Chick wants a full week's Emperor's package at Caesar's Palace. Hey, you guys wouldn't be able to tell us who actually killed Kennedy, would you? Bear would like to stay at the White Horse.
White House. White House.
White House, yeah, he'd like to stay in the Lincoln bedroom of the White House for the summer. Stuff like that.
Sure, I think we can take care of some of that.
Harry.
Yeah, one more thing. None of them want to pay taxes again. Ever.
Well, I can't say that the final conference committee went quite that far, but they certainly did make some significant changes and gave some big tax breaks to both C corporations and then to what I refer to as pass-through entities, S corporations, partnerships, LLCs, taxes, partnerships, and sole proprietorships. We'll start by looking at the C corporations. I'll come back to that slide. Effective, for taxable years beginning after 12/31/2017, and I know you've all heard about this. This has been highly touted. The rate applicable to corporate income is a flat 21%. Now that's contrasted with the prior rates, graduated rates, which range from 10% to 35%. And the interesting thing about this is what this says is that this change is permanent. Every other change in the bill is not permanent, and that's in the sense that these other changes sunset in 2026, and in order for them to continue, you're going to have Congress pass those again, whereas supposedly the 21% rate is, and again, I'll put in quotation marks, permanent, okay? So, obviously, and this was one of the driving forces, as Charlie said, to make our publicly held multinational corporations competitive internationally. And certainly, when you look at some of the tax savings estimates that some of the agencies have done, C corporations by far are the largest beneficiary of the tax benefits from this tax act. Well, there are a few other changes to C corporations. I'll just mention one of them, and that was the repeal of the alternative minimum tax. And that was very important to C corporations because they said if you reduce the rate to 21% but don't eliminate the AMT, we're not going to get that much benefit out of it. Unfortunately, and I'm not sure Jane mentioned that, but there still is an alternative minimum tax on individuals, and that is an unfortunate thing. What I wanted to point out, though, so that's the driving force. C corporations, flat 21% rate, but when you look at this chart, you're going to see that a majority of America's businesses aren't run through C corporations. They're run through pass-through entities and sole proprietorships. I kind of like to refer to these types of businesses as Main Street businesses versus Wall Street businesses, the publicly traded corporations. So what they enacted Section 199A, and that's the deduction for 20% of qualified business income of these pass-through entities and sole proprietorships. And really, this was done to, again, try to level the playing field between C corporations and these other types of entities, which, again, by far outnumber the C corporations. So there was a lot of pressure from a lot of different groups. You know, Charlie and I spoke to some senators and other folks, and tons of trade groups said, look, you got to give a break to the pass-through entities too, not just to these large C corporations. So anyway, what we ended up with was Section 199A, which generally allows a 20% deduction for a shareholder's, partners, members, or sole proprietor's allocable share, and I'll talk about allocable share a lot in the next few minutes as I talk about the deduction here, of that business's qualified business income. Okay. I'm going to refer to qualified business income throughout the rest of my portion as QBI, just because it'll save us some time, and it's a mouthful. So what you're going to find out in the next 30 minutes or so is that in order to determine what your QBI deduction is, you have to go through a really complex set of rules, lots of new defined terms. There's limitations, there's thresholds, there's phase-ins, there's phase-outs, and in the end, there's just a lot of unanswered questions because of the way this thing was passed at kind of the last minute with a lot of handwritten changes and not necessarily well thought through. That doesn't mean it's not going to benefit pass-through entities, but it certainly raises a lot of issues. Well, let's go ahead.
Steve, one quick point, just in fairness. They had to deal with the possibility that people would game the statute, namely quit paying themselves compensation and have all their income be qualified business income and therefore get a 20% deduction on that. So they had to build in some safeguards, some guardrails into this, and unfortunately, as Steve was about to tell you, they do get a little complex.
Guardrails not only get a little complex, they can create some anomalous results, as we'll talk about in a few minutes. Well, and I also should mention, and some of the slides will show this, but this 199A deduction also deals with dividends from qualified real estate investment trust, or REITs, as we refer to them, dividends from qualified cooperatives, and we'll mention that briefly because there's a real glitch in the bill for cooperatives, and income from publicly traded partnerships. But in order to simplify my discussion and make it applicable to what I think most of you guys are going to deal with, and that is going to be just disregarding those things and just looking at the QBI deduction. So what is the general rule? The general rule is for taxable years beginning after December 31, 2017, and before January 1, 2026. Again, this provision expires just as a lot of those individual changes that Jane talked about. What you have is a rule which provides that taxpayers, including estates and a trust, and estates and a trust were only added at the last minute in the conference committee. We saw a clip from the conference committee before. But they were added at the last minute, that allows those taxpayers to generally deduct their allocable share of 20% of the qualified income from S corporations, partnerships, LLCs, and sole proprietorships. To point out, in order to obtain the full benefit of this QBI deduction under 199A, the full 20% of qualified business income, you have to be, your taxable income of the shareholder, member, or partner has to be below a certain threshold amount. And again, this is one of the new defined terms. Threshold amount is $315,000 for married taxpayers filing jointly. It's $157,500 for other taxpayers. So if you're under those threshold amounts in your taxable income, then you're going to get the full benefit of the deduction, 20% of QBI. Well, what does that mean? Basically, that means when you look at effective tax rates, 20%, as most of you all know, pass-through entities and sole proprietorships aren't taxed at corporate tax rates. They're not taxed at the 21% tax rate. They're taxed at individual rates. As Jane pointed out, the top marginal rate now is 37%. But if you're able to utilize the full benefit of this QBI deduction, it actually takes your maximum marginal rate on the qualified business income of one of these entities down to 29.6%. So again, that's if you get the full benefit. There's an example on the materials, but I'm not going to go over that. What I want to go into is, well, the first question, of course, is what is qualified business income? That's one of our many defined terms under 199A. Well, it basically means the net amount of qualified items of income, gain, loss, and deduction, but it excludes certain amounts. Basically, it only includes domestic income and not foreign income. That's that's one exclusion from the QBI. Additionally, 199A tells us that certain investment-related type income doesn't qualify as qualified business income. And what we're talking about there are things such as short-term and long-term capital gains, interest and dividends, among a litany of other ones. Also, specifically excluded from the definition of qualified business income is reasonable compensation paid by an S corporation to its shareholder employees, and also any guaranteed payments made by a partnership to its partners. And these things become very important later as we talk about the limitations, the wage and capital limitations that I'll talk about. So we have that, but we also have a threshold question that we move on to, and that is, well, we start with what is a qualified trader business, but break that down. Let's start at the bottom. What's a trader business? Well, that's an interesting question because Section 199A itself doesn't define what a trader business is. And we've had, I don't know, give or take 100 years of judicial precedent that hasn't necessarily given us a bright line test for what qualifies as a trader business. Probably the most typical definition would be a trader business under 162, and you have to meet certain requirements in order to meet that. But that opens the question, again, an unanswered question is, what is a trader business for Section 199A purposes, even before you get to whether it's a qualified trader business? And I'll just throw this out here to Charlie. And say I have a commercial piece of rental property. I lease it out on a triple net lease basis. I report that on Schedule E. Do I get the 199A deduction? What do you think?
No.
I think you're right. So, what I think you're going to see is a lot of litigation over what constitutes a trader business. And uncertainty is good for us, I think, tax accountants, tax attorneys. It's not so good for taxpayers. It's hard to plan when there's uncertainty. So after you get past that definition of a trade or business, let's just assume we have a trade or business. Okay, we're operating a factory or something. Well, what is a qualified trade or business? Well, basically, a qualified trade or business is a trade or business with certain exclusions. First of all, it does not include a specified service trade or business. And we're going to go back to that and talk about what's a specified service trade or business. But for right now, just remember, they are not qualified trades or business. 199A also specifically tells us that being an employee is not a trade or business. Your salary that you receive in the form of W-2 wages, you can't take the 20% deduction under 199A. So that gives you your general definition of what a qualified trade or business is. Again, I think you're going to have some questions there and potential litigation. And we'll see that when we get to the specified service trade or business, and whether or not you are a specified service trade or business versus a qualified trade or business. Just a few other things to talk about before we get into the computations, and I'll skip over allocable share right now. But you should keep in mind that if in 1 year you have, say you have a $100,000 loss from your qualified items of income gain, deductions and losses. Well, when you're computing your QBI for the next subsequent taxable year, let's say it's $200,000. Well, you had a loss of $100,000. That has to carry over and actually decreases your $200,000 by $100,000. So, without talking about the limitations, instead of 20% of $200,000, you would only get 20% of $100,000. So that's something to keep in mind. As far as the mechanics of the deduction, it does not reduce adjusted gross income. It does reduce taxable income, and it's available whether you itemize deductions or not. And a little quirky thing I thought I'd throw in, a lot of you are familiar with, there's something called an accuracy-related penalty under Section 6662, and it's imposed among other things, on substantial understatements of tax. Well, it's a 20% penalty on the substantial understatement. And interestingly, the substantial understatement for all other purposes is really defined as 10% or more of the tax that should have been stated on the return. Well, they said for this 199A purposes, we're going to make it a lower threshold. We're going to make the accuracy-related penalty apply if your understatement is just 5%. So just something to keep in mind when you're making those calculations, that you're more likely to have the substantial understatement penalty applicable than in other situations. Well, that gets us down to, let's talk about the deduction. And what I'm going to refer to first is the statutory language itself, and then I'm going to simplify it for, as I said, excluding some of these things like cooperatives and REIT dividends and publicly traded partnerships. Well, the statute tells us the deduction is the lesser of the combined qualified business income of the taxpayer, or 20% of the excess of taxable income over the net capital gain of the taxpayer, plus the lesser of 20% of qualified cooperative dividends or taxable income less net taxable gain. Now again, I just kind of struck through those two things because we're going to ignore them for most of my discussion because it's not applicable to most operating trades or businesses. Well, what's the combined qualified business income? Well, this is really what the deduction is based on. It's basically equal to the lesser of the taxpayer's allocable share of 20% of the qualified business income of the qualifying trade or business, or the greater of two amounts, either 50% of the W-2 wages paid with respect to that qualifying trade or business, or 25% of the your allocable share of the W-2 wages paid with respect to the qualifying trade or business, plus your allocable share of 2.5% of the unadjusted basis. And again, unadjusted basis is important. It's before depreciation of all so-called qualified property. And then again, we have this other plus 25% of qualified REIT dividends and qualified publicly traded partnership income, which we're going to ignore. So you're basically looking at, it's the lesser of 20% of QBI or the greater of the two limitations, which I refer to as the wage and capital limitations. So that leads us really to one of our first questions, which I know a number of you have, and that is, what are W-2 wages? Well, this is somewhat problematic. I mean, the 199A does define W-2 wages as wages paid to an employee, all right? And it can include elected deferrals to plans like 401k plans and so forth. But it specifically provides, it doesn't include payments to independent contractors or payment of management fees. Well, that raises a question immediately, a couple of questions immediately. First of all, what if you have a separate entity, a management entity, where all the employees are hired, they pay the W-2 wages, and they lease or provide those employees to your operating business? Can you count those W-2 wages? Because it's important, because if the business doesn't have any W-2 wages, keep in mind 50% of zero W-2 wages is zero, and that's going to be the lesser of the two amounts, and you're not going to get any deduction under this new 199A for qualified business income. Well, again, these are unanswered questions as far as the management goes. The way the statute reads, it does say W-2 wages paid with respect to the qualifying trade or business, so I could make an argument that fees paid by an affiliated management company should apply. But, again, it's an unanswered question right now. Clearly, if you use an independent contractor, at least at the present time, unless they change the law, those amounts are not going to count as W-2 wages for purposes of the QBI limitation. And again, that can be good or bad depending on what your income level is, as we'll talk about in a minute. The other component here is the fact that, I think since there was a revenue ruling in 1969 that said partners cannot be employees of partnerships. So when you pay your partners, even if you make a guaranteed payment to them, although I think they report that more or less kind of like it's a W-2 payment, it isn't a W-2 payment. So from a plain reading of the statute, guaranteed payments made to partners are not going to be part of that W-2 limitation. And again, if you don't have any outside employees and you're just paying your partners, they may get no benefit from the QBI deduction, as I'll demonstrate with some examples in a few minutes.
Steve, just quickly,
Sure.
One observation is this is not simplification.
Absolutely.
The second is that there are a lot of these questions, some that you haven't even gotten to yet, obviously, that are going to have to be addressed in guidance from the IRS, from Treasury.
Right.
And it may be that some of these have to be fixed in a technical corrections bill. We'll have to see. But I know that the service is going to announce the priorities of when they're going to get out, which areas they're going to give advice on first. And we're all hoping that this is at the top of that list.
This needs to be at the top of the list, absolutely. But I agree with you. And as you mentioned, a technical corrections bill, well, we've had statements from our Treasury Secretary Mnuchin that he didn't think we need a technical corrections bill, which, of course, I think is absolutely ludicrous. But the real problem here is any type of technical corrections bill is going to require the normal vote, not just a simple majority vote in the Senate, but a vote, I think, of 60 senators. And the Democrats may or may not cooperate, since they feel like they were excluded from the passage of this bill. So I don't know when or if we'll see a technical corrections bill, and I've heard estimates from the service that some guidance, obviously if it's in the form of regulations, it is going to take a while. Hopefully, as Charlie said, we'll get some temporary guidance in the short term on some of these unanswered questions. I'll just say, as far as what are W-2 wages, you may be able to look at the regulations and some of the guidance that was out there under old Section 199. And for people who are aware, may be familiar with that or not, it dealt with the domestic productions activity deduction. Now, again, I can't say you can fully rely on that, but there is some guidance out there you might look at as to whether something constitutes W-2 wages. Now, the next question really is, and it's before, I'm going to skip down to the allocable share. What is the taxpayer's allocable share of qualified business income or W-2 wages for that matter? Pretty easy answer in the case of an S corporation where you have multiple owners. It's just your percentage ownership in the stock of the S corporation. Gets a little bit more difficult when you look at partnerships. As you all know, partnerships can have special allocations. So what 199A tells us basically is a partner's allocable share of QBI and W-2 wages will be equal to whatever his allocable share of the ordinary income of the partnership is. So that answers the allocable share question, but you just need to keep that in mind. And you have a different standard when I'll get down to your allocable share of the unadjusted basis of qualified property. Which leads us to what is qualified property. Remember I said there were two limitations on the 20% of QBI deduction, and it's the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of the unadjusted basis of so-called qualified property. Well, what is qualified property? Basically, it's tangible property that's of a character that's subject to depreciation. I mean, that's pretty straightforward, but it's kind of like four requirements that have to be met. Number one, that property has to be held at the close of the taxable year. At some time during the taxable year, that property had to be used to generate the QBI of the trader, of the qualified trader business. And also, the depreciable period for that qualified property must not have expired. But here we have a special depreciation period for purposes of Section 199A only. Again, we have lots of special rules, defined terms, and just a litany of things to go through. But it's this definition is actually beneficial for taxpayers. The depreciable period for qualified property begins when it's placed in service and ends on the later of the date that is 10 years after the date the property was placed in service or the end of its normal depreciation period. So it's fairly generous. And remember, you're talking about unadjusted basis. So generally before depreciation, although again, there are questions here about 179 expensing and if that affects it or not. And this was one of those things that was thrown in at the last minute in the conference committee too, because a lot of owners of real estate, I think Trump owns some real estate, I'm not sure, said, well, gee, I got millions and millions of dollars of real estate, and assuming I have a trader business, because it's a multiple property that probably qualifies as a trader business, I'm not going to get any deduction where I don't have any employees. So I got to have something based on capital too, and that's the 2.5% of the unadjusted basis of the qualified property immediately after it's acquired. So that could be a very significant amount for some folks. And that was done basically for the real estate folks, and that's how the sausage is made in Washington. So that comes through. What we move on to next just further extends the complexity of the act. As I said at the beginning, to get the full benefit of that 20% deduction, the taxable income of the shareholder or member or partner has to be below those threshold amounts. That's $157,500 or $315,000 with married individuals filing jointly. And I can see I'm probably going to go over my time by just a bit, so I'll try to go quick. Very quickly, the wage and capital limitations are phased in for people having income, for taxpayers having income between $157,500 and $207,500, or between $315,000 and $415,000. And they have a new defined term, the excess amount. I have an example. It's example 3. It goes through it. It is a complicated, but there's going to be plenty of programs, computer programs out there that are going to be able to figure your QBI deduction and your thresholds, phase-ins and phase-outs, and all of that kind of stuff. So, basically, the challenge is getting the right figures in there in the first place. What are W-2 wages? What is qualified business income? As we all know with computers, it's garbage in, garbage out, so you got to have the right figures. Well, let me move on now. I'm not going to go over that in depth. You're going to have computer programs for that. What's a specified service trader business? I already said it's not a qualified trader business. Well, it's specifically defined as a business involve the performance of services in the areas of health, law, accounting, actuarial science, performing arts, consulting, I'll come back to that, several other things, athletics, financial services, brokerage services, and they threw in this zinger, any trader business in which the reputation or skill of one or more of the employees who are owners is a principal asset. Well, that's a pretty broad and vague definition. So again, I think you're going to see, because specified service trader businesses don't nearly get the same benefits that qualified trader businesses do, you're going to see a lot of probably audits, appeals, and litigation over what constitutes a specified service trader business, especially with respect to consulting, or where they're alleging that one of the principal assets is the reputation or skill of one of the employee owners of the business. Now, I told you at the beginning, a specified service trader business is not a qualified business. So does that mean it doesn't get the deduction? Well, no. It does get the deduction, but only in certain circumstances. Where the taxable income of the shareholder, member, or partner is below those threshold amounts I mentioned, even if you're in a specified service trader business, you get a deduction for 20% of your QBI. And just like qualified trades or businesses, here I would say you're not phasing in your wage and capital limitations, you're just phasing out your ability to, you're phasing out your ability to take the deduction. And what's important here, and the big difference is, if you're a qualified trader business, even if you're over the thresholds fully phased in, you can take the deduction subject to those limitations, the wage and capital limitations I discussed. If you're a specified service trader business and you're over the fully phased in taxable income limit, you get zero deduction. And that's why there's going to be a lot of fighting on what's a specified service trader business or not. And the phase-in rules are very complicated. I have an example that goes on for over a page, example 5. And interestingly enough, when you look at that example compared to the phase-in example for a qualified trader business, you can see this is much more harsh, because on the same set of facts, incomes and everything, when you use the threshold rules in these examples, you get a $9,600 deduction, whereas if it was a qualified trader business, you would have received a $32,000 deduction. Big difference. Well, at the beginning, I also said there's one more limitation that goes on top of all these things. And that is basically that the deduction cannot exceed your tax, the 20% of the excess of the taxpayer's taxable income over his net capital gains. And that does make sense when you think about capital gains are already taxed at 20% rate. So just keep in mind that there is this overall limitation. Well, let's make some observations about the QBI. Those are the mechanical rules on how it works, with a lot of unanswered questions. As Charlie said, there's a lot I haven't even raised. I think there was a set of 20 questions or so the AICPA, American Institute of Certified Public Accountants, submitted yesterday on 199A alone. But there's some interesting results on choice of entity, even when you're looking just at pass-through entities and don't even factor in C corporations. And those differences are principally based upon two principles. Number one, and again, I won't get into the details because of time, S corporations, because wages are subject to FICA taxes, but distributions are not subject to self-employment or FICA taxes, have employed a strategy of minimizing wages and maximizing distributions. I'm all sure you're very aware of that, and there's a gray area. But because of that, the IRS has come in and said, we can recharacterize distributions of an S corporation as wages subject to Social Security taxes if you pay unreasonably low compensation to your shareholder employees. And I've just cited a whole bunch of the revenue rulings and case law that deals with that, and that's a whole subject unto itself. The second factor that makes this anomalous results between the different types of pass-through entities and sole proprietorships is what I mentioned before. Well, first of all, the reclassification risk, at least now, doesn't apply to sole proprietorships or partnerships. There's no such concept as unreasonably low compensation for a partnership. Now, there might be under the new law, and that remains to be seen. Of course, the other distinguishing factor here is what I mentioned before. S corporations can pay W-2 wages. Partnerships and sole proprietorships really can't. So that can lead to these anomalous results. Pardon? To their partner owners, that's right. Obviously, outside employees of a partnership, you can pay W-2 wages. What I've done with these last two examples, example 8, I assumed we kind of had a high income, and by high income, we're over the threshold. 600,000 of QBI, we're assuming 600,000 of taxable income. We're kind of forgetting about the standard deduction. But bottom line is, if you work through this, for the sole proprietorship, since he's not paying any wages and he's over the threshold, his deduction is going to be zero. 50% of W-2 wages is zero. If the partnership, even if it pays a $150,000 guaranteed payment to one of its partners, that doesn't count as a W-2 wages. Well, wait a second. If the S corporation has to pay some salary, let's assume it pays $150,000. Well, as you can see in example number 8, in that case, it gets a deduction equal to $75,000 versus a sole proprietorship or partnership at zero. That doesn't seem fair when they have the same amounts of income. Now take a look at example number 9, which I call my low income example. You have $300,000 of QBI and taxable income. Well, those limitations the wage and capital limitations don't apply. So if you're sole proprietorship or a partnership and you don't pay a guaranteed payment, let's say you assume you don't, what's your deduction going to be? It's going to be 20% of QBI or $60,000. But in the S corporation, even at a level of $300,000, you have to pay reasonable compensation to your shareholder employees. And I've assumed in the example that they paid themselves a salary of $100,000, so that reduces QBI from $300,000 to $200,000, so you only get a deduction of 20% of $200,000 or $40,000 versus the $60,000 that the other two type of entities gets. Well, I think it's very doubtful that Congress intended to have these different results between these entities when they have the same amount of income and basically the same circumstances. But I'm not sure they gave any thought to it when they were passing this at the midnight and had handwritten changes on the bill. I do think there are some fixes that could come through. We could have reasonable compensation concepts we see applied to partnerships and sole proprietorships, and then deem those amount to be W-2 wages for purposes of the limitations to more or less equalize the playing field. But as the plain language stands right now, we have these anomalies. So you're taking your risk if you take a different interpretation of that. Well, now I want to kind of end up on my portion, and again, I know I'm a little bit over, but the question everybody's asking, wow, the C corporation rates decreased to 21%. Shouldn't I be a C corporation? Should I convert my sole proprietorship, my S corporation, or my LLC to a C corporation? Well, that's what we're going to talk about right now, choice of entity. And again, this is not an exhaustive discussion, it's just really dealing with the rates. First thing to keep in mind, as Charlie mentioned, I think, you still have the double tax on C corporations. So even though you have that 21% tax at the corporate level on the income, if you do indeed distribute that income out to the shareholders, you have a second level of tax at the shareholder level. And most likely, well, you have a qualified dividend rate of 20%. The net investment income tax is 3.8%. So you could have another 23.8% tax on those distributed earnings. And you work out the mathematics, that leads you to a maximum marginal rate on the distributed earnings of a C corporation of 39.8%. And that's not even taking into account the fact that in Florida, a corporate income tax is imposed on C corporations, but not on partnerships or S corporations. And so when you factor that in, that kind of increases your marginal double tax rate to a little over 43%. Charlie?
And by the way, Steve, suppose you want to sell that business.
Oh, we'll get to that. We'll get to that. Good question. That'll be the next question. Well, but before we get to that, you say, okay, I'm a smart guy. I'm going to get the benefit of the 21%, and I'm not thinking about the sale of the business yet. So I'll just accumulate that income inside. Well, I'm going to make things brief here. Service has an arsenal of tools to use to attack earnings that are retained in a C corporation that aren't distributed out, lots of which we haven't dealt with lately because we haven't dealt with C corporations for many years, for the most part. But first of all, I think an intriguing aspect of this is you might actually see unreasonably low compensation arguments brought up in the C corporation area if you're not distributing reasonable salaries to your shareholder employees. I mean, traditionally, it's unreasonably high compensation. I think Jane's dealt with that a lot. But I think you may see the opposite now. Additionally, there's a little thing known as the accumulated earnings tax that imposes a tax on C corporations if they accumulate income in excess of the reasonable needs of the business. And it's basically 20% of the accumulated taxable income, which is your taxable income with certain adjustments. And they give you kind of a freebie of $250,000. That's the accumulated earnings credit for most businesses. However, if you're in one of those service trades or businesses, oh, and I forgot to mention this, and I should have mentioned this. In the service trader businesses, there are two professions that are really locked out. Engineers and architects are not included in that. I don't know what power they had or what senator's ear they had, but they had a lobby so that architects and engineers are excluded from the definition of a specified service trade or business, so they get to act like any other qualified trade or business. So I think that's important. Here, though, for purposes of the accumulated earnings tax, I don't think any definitions were changed. So your exemption, rather than being $250,000 for the specified service trades of businesses, which here would include architects and engineers, is only $150,000. There's also another tax known as the personal holding company tax. Again, when your assets consist primarily of personal holding company income. We're talking about interest, dividends, rents, annuities, things like that. And it's a 20% tax on your undistributed personal holding company tax. So those are the three tools they have to fight if you think, I'll just accumulate the income and play off the present value of money because I'm paying the low 21% tax rate. Well, as Charlie said, well, what about if you sell the business? Well, again, you have that double tax if you sell the assets of a C corporation. If you sell the stock, you don't have that problem, but as I think most of you know, buyers much prefer to buy assets versus stock, and if they are going to buy stock, they're probably going to decrease the purchase price because of that built-in gain in that's subject to taxation eventually. So what's your double tax on a sale of the business? Again, it's going to be 39.8% or factoring in the Florida corporate income tax, almost 43%. Well, contrast that to the sale of assets of a pass-through entity or sole proprietorship where you allocate, and usually are successful in allocating, a bulk of the sales proceeds to capital assets, namely goodwill, where your maximum rate, if you materially participate in the business, is going to be 20%. That's over double the tax if you're selling your assets of a C corporation versus selling the assets of a pass-through entity or sole proprietorship. Additionally, all right, maybe you're still not convinced after I've talked about that. You still want to be a C corporation. You need to keep in mind just a few things. Once you convert to C corporation status, it's not that easy to get out of C corporation status, and there are a number of toll charges that are imposed if you try to go back to a partnership or even an S corporation. First of all, if you're a C corporation and you want to go back to a partnership or S corp or sole proprietorship, that's a fully taxable liquidation, and that's phantom income because you've just liquidated, and that doesn't leave you with a very happy result. I should also mention that the reason I say you're trapped in C status is because, not only because of this, but at the beginning I said that change was permanent as opposed to it being sunsetted like the other changes. Well, permanent only means permanent in the sense that it doesn't expire automatically. That doesn't mean that the next Congress doesn't come in and raise that 21% closer to 25 or 28%, which makes being a C corporation much less advantageous than before. Just the other things, S corporation, you convert to C, you basically have a 5-year waiting period before you can re-elect. So if they change the law or something, you're stuck for those 5 years. And not only that, there's a whole bunch of other taxes that can be imposed when you convert from C to S, but the most important of which is the built-in gains tax, which is really set to mimic the double tax on C corporations, and it applies for a period of 5 years after you've converted to your built-in gain. So let's just think, you converted from S to C because you thought C looked so good with these 21% rates. You can't convert for 5 years, and you can't sell for 5 years, or you're going to be subject to the built-in gains tax. So I think, what's the takeaway from all this? When you get the question about C corporations, yes, there probably are some situations where a C corporation might make sense. You got to run the calculations, you got to do the QBI calculations, but the problem is you almost have to have a crystal ball. What's your future income going to be? What's your payroll going to be? Employees, independent contractors, management company. When are you planning to sell the business? Or are you planning? A lot of times offers come out of nowhere and they're too good to refuse. If you're in C corporation status, you got that double tax. And we don't know what Congress is going to do. So my advice on those folks who are itching to convert to C corporation is don't act impulsively. Just kind of sit back, take a deep breath, relax, and go meet with your tax accountant and tax attorney, and let's do a thorough analysis to see whether that should be done. And that's the simplified QBI deduction and the tax, and it really simplified choice of entity rules too. I'm going to turn it over to Ed now for some more business changes that are real simple.
Yes, indeed. Thank you, Steve, and good morning, everyone. Now that we're through kind of the easy stuff, I'm going to get kind of more into the real technical stuff. No, I'm obviously kidding. So here we go. So beginning with the limitation on the deduction for business interest, this is new code section 163J. The limitation is the sum of the three items that you see there on the screen: business interest income, 30% of adjusted taxable income, and floor plan financing interest. All of those terms are defined in the statute. The only one that you might not know about, that last one, is interest paid on indebtedness used to finance the acquisition of motor vehicles held for sale or lease and secured by the inventory so acquired. That interest is fully deductible. I have a pretty easy example here, just kind of demonstrating the limitation. ATI $20,000, business interest income $2,000, and business interest expense $10,000. The deduction would be limited to $8,000, and you would then carry forward the remaining $2,000 that is disallowed by the limitation, and that may be carried forward indefinitely, as I will address in a later slide. One important exclusion from this limitation on business interest is that the limitation does not apply to taxpayers who have average annual gross receipts for the preceding 3 taxable years less than $25 million, and that is based on gross receipts, so that's not necessarily a huge threshold. You might be able to meet that. Okay, so we have 3 definitions here. All of these definitions are included on page 33 of the outline, which is kind of where I'm at in the outline right now. I won't go through it, but ATI is just taxable income computed without regard to some items listed there, and then business interest and business interest income. Pretty self-explanatory, except they do not include investment interest under code section 163D3. As I said, the disallowed business interest as a result of the limitation may be carried forward indefinitely. The general rule is that the amount of business interest not allowed as a deduction as a result of the aforementioned limitation is treated as business interest paid or accrued in the following tax year and then may be carried forward indefinitely. There is a special rule applicable to partnerships. It is included, the full text of this special rule is included on page 34 of your outline. Due to time, I'm not going to go through it all, but just to kind of summarize how that carry forward operates with respect to partnerships, a partner may deduct his or her share of a partnership's excess business interest in any future year, but only against excess taxable income, yet another defined term in 163J, attributed to the partner by the partnership whose activities gave rise to the excess business interest carry forward. Any such deduction requires a corresponding reduction in excess taxable income, and I will address excess taxable income more here in a moment.
Ed, I think that these new interest limitation rules, there is an exception if you're a business and your average annual gross receipts are less than $25 million for the preceding 3 years. Those rules don't apply to you. Is that?
Yep.
Yeah.
Yep. That was, I think, on a previous slide. So yeah, average annual gross receipts, 25 million for 3 years. These rules do not apply. Maybe the only bit of nuance with respect to this new limitation is there are special rules applicable to partnerships, and the statute does provide that similar rules apply to S corporations as well. You see those special rules there on that slide. The one I have bold, adjusted taxable income of each partner is determined without regard to such partner's distributive share of any items of income, gain, deduction, or loss. Okay, what does that mean? Well, that's just intended to prevent double counting. Without this rule, the same dollars of ATI of a partnership could generate additional interest deductions as the income is passed through to the partners. And I do have an example here that kind of illustrates that. I'll go through it very quickly. We have AB partnership has partner A corporation and individual B are the two partners, 50-50. AB has $1,000 of non-interest income, and AB's only expense is $300 of business interest. Their deduction under this limitation is limited to $300, which is also the amount of their business interest. AB's business income, therefore, is $700, and A's distributive share of that business income is $350. A has zero taxable income from other operations, but has an additional business interest expense of $100. If not for this rule, A's $350 distributive share would allow A to deduct an additional $105 of business interest. As a result, A's $500 share of AB's $1,000 ATI would create $255 of interest deductions, which is, if you do the math, 51%, well in excess of the 30% ATI limitation contemplated by the statute. So that just kind of shows you how this rule operates. What the rule does provides that ATI shall be computed without regard to its A's $350 distributive share of AB's non-separately stated income. Thus, A has ATI of $0 for that purpose, resulting in the $100 of business interest deduction disallowance. Okay. You see the other rules applicable to partnerships here. That middle one, adjusted taxable income of each partner is increased by such partner's distributive share of excess taxable income. That invokes the definition of excess taxable income that I referred to earlier. And what this rule does is allows a partner to deduct additional interest expense the partner may have paid or incurred to the extent that the partnership could have deducted more business interest. I do have a quick example showing that as well. Kind of uses the same facts as before. That's the definition of excess taxable income. It's pretty convoluted, and it's in the outline. But I think in this example that I have here, I can kind of demonstrate easily what excess taxable income is under 163J. So if we just kind of assume the same facts as before, except that AB, the partnership, only has $250 rather than $300 of business interest, the excess of the limit, which would be $300, over the amount of the business interest that the partnership has, $250, is $50. And as a result, excess taxable income is calculated thusly. 50, the difference between the limit and the amount of business interest, over 300 times $1,000, which is the ATI of the partnership, gives you $166.67. And that's the excess taxable interest, and then A's distributive share of that is 83.33. And what this does is A's deduction for business interest is limited to 30% of the sum of A's ATI plus A's distributable share of excess taxable income. In the example before, A's ATI is 0, and the excess taxable income, therefore, is 83.33. Multiply that by the 30% limitation. You have $25. Thus, A may deduct $25 of business interest, resulting in $75 of the business interest deduction disallowance. Okay, rules similar to these apply to S corporations except for the carry forward rule that I kind of just breezed through earlier. This limitation is applicable at the entity level, so the corporate partnership, what have you level. And in the statute, you'll see that certain trades or businesses are excluded from the definition of a trade or business for these purposes. So you might want to look through that as well. Moving right along. Okay, modification of bonus depreciation, Code Section 168K. Pretty self-explanatory for property, place, and service between those dates. So the first threshold there, or the first dates there, September 27th, 17 through December 31st, 2022. Bonus depreciation increased to 100%, and that just kind of cascades down there for property placed in service in those other dates, all the way down to 20% for property placed in service between January 1st, 2026 and December 31st, 2026. Also maybe worth mentioning is that used property, that is property whose original use does not begin with the taxpayer, may constitute qualified property subject to bonus depreciation if it meets those 3 requirements there. Prior to the act, the original use of property was required to originate with the taxpayer in order for property to constitute qualified property subject to bonus depreciation. So keep that in mind as well. Finally, for me, we have a couple of modifications to the expensing provisions under Code Section 179. A couple of thresholds were increased here. Aggregate cost, which can be taken into account under Code Section 179, is increased from $500,000 to $1 million. And the $1 million limitation is reduced dollar for dollar by the amount by which the cost of Code Section 179 property placed in service during the taxable year exceeds $2.5 million. This amount was $2 million prior to the act. And finally, the Act also expanded the definition of qualified real property under Section 179, replaced those 3 requirements there: qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property with the concept of qualified improvement property. This is a significant expansion over the previous 3 buckets, if you will. And just so you know, qualified improvement property, I have this in the outline as well, is defined as any improvement to an interior portion of a building which is non-residential real property if such improvement is placed in service after the date such building was first placed in service. So, like I said, that's an expansion over the previous 3 kind of buckets. And with that, I'm going to pass things over to Chris.
Okay, thank you. So I'm going to touch on the modification to the net operating loss deduction. Changes were made to Code Section 172. Just to recap, prior to these changes, generally net operating losses were carried back 2 years and then forward for 20 years. Under the new changes, net operating losses arising after 12/31/17. I'll talk about some of the effective date problems with this in a second, but are carried forward indefinitely, and in most cases can't be carried back. There are some exceptions for farm and insurance losses. Again, under the prior act, net operating losses were not subject to any limitation based on taxable income. Under the new changes, the amount of taxable income a taxpayer can offset with net operating losses carried forward after 12/31/17 will be limited to 80% of taxable income. So this is going to be a material limitation on the value of net operating losses going forward. There's a slight problem with the effective dates under these changes. There's basically some of the limitation losses and the changes in 172 take effect with respect to losses arising in taxable years beginning after 12/31/17, and some of the changes apply to losses arising in taxable years ending after 12/31/17. So basically for calendar year taxpayers, this isn't probably going to be an issue, but for some fiscal year taxpayers, this glitch in the effective dates will mean that some taxpayers may have net operating losses that will be limited, and some will have net operating losses that won't be limited. The Senate Finance Committee published a report that basically referenced 12/31/17 as the effective date for these changes. They did acknowledge this glitch in the statute, and I'm not sure how they're going to fix it. And Steve, I think Joint Committee on Taxation said there's no plan for a technical corrections bill in the works. So I'm not sure what they're going to do for that, and I'm not sure how you're going to deal with it if you have a fiscal year taxpayer with those problems. In addition, to go on for there's new limitations. There's a new code section 461L This is going to further limit losses for non-corporate taxpayers. It takes effect 12/31/17 and again sunsets in 26. This creates a new concept of excess business losses. There's a formula here with respect to how you determine that. I think in essence, you basically, the losses or deductions that you're going to have are going to be limited, and we'll talk about a little bit of the language of the statute in a second, but basically if you're $250,000, otherwise if you're a joint filer, you're going to get $500,000. So you take the amount of the losses, subtract $250,000 if you're not a joint filer, and the excess is going to be limited. That loss is then going to be a net operating loss carried forward. And again, I just told you that those net operating losses are going to be limited, carried forward to 80% of taxable income. So, so those changes are going to be significant. There's some commentary about the way that this language is drafted for 461L with respect to whether wages are included in income from a trade or business. I think as Steve mentioned before in 199A, the statute specifically excludes wages. I think in some of the commentary discussing 461L, there was reference made to excluding wages from this calculation. There's nothing in the statute that excludes it. This probably would only come into effect for people that might have wages that are unrelated to the taxable income that gave rise to the net operating losses. So that in essence, if you include wages, you would end up being able to deduct more and lowering the what is now the excess business loss. So just a little point out there. It's maybe a glitch. It maybe gets fixed. Maybe it was intended. The $250,000 and $500,000 the base that you get there for computing the losses, those are going to be indexed for inflation starting in 2019. For partnerships and S corporations, this limitation is applied at the partner and shareholder level. So again, you're going to have to go through your basis, your basis limit calculations, your at-risk limitations under 465, your passive activity losses under 469, and then you're going to go in and look at this 461L and see if you have further losses. And I think that's it. I think I brought us up some time, Charlie, and turn it over to you.
Okay, thanks. First thing I want to do, I'm going to deal with some real estate related changes and partnership related changes. In the real estate area, the main thing I want to bring up is that Section 1031, which has been around since the Revenue Act of 1921. And basically, it provides that if you have a piece of property, real or any property originally, that is held for investment or for productive use in a trade or business, and you dispose of that property and receive in exchange a replacement property in which all of your investment is carried over, that was deemed to not be an appropriate time to extract a tax because you haven't bailed out, you haven't cashed out. You can argue the merits of that, but it's been here for almost 100 years. We almost lost this provision in its entirety as part of the Tax Reform Act. One of the earliest Republican proposals would have repealed Section 1031 in its entirety, and the Democrats had a similar provision. The compromise that was worked out is that Section 1031 is still around, but it now applies only to real estate. And Section 1031, the bulk of the transactions under 1031 even today are real estate related, but there were a lot of people who were using these, for example, for fleets of cars or trucks or airplanes, and they had written off their investment, but the assets had still some residual value. They were basically turning those in, getting replacements, and completely avoiding tax. Most of the real kind of abuses, if you will, in this area were in the area of tangible personal property. Effective for exchanges carried out after December 31, 2017. 1031 will continue to apply, but only for real property. a couple of interesting questions. We've gotten a lot of questions from clients already. Suppose, for example, you've done a cost segregation study on a piece of real property, and we've carved out certain parts of that and basically treated them as tangible personal property because we got a faster write-off. And we want to dispose of that property in a Section 1031 exchange. Query, are those assets that have been reclassified as tangible personal property to get that rapid write-off, is that real property that's eligible now for a 1031 exchange? Is that component, can we still do that? That's an unanswered question. In all likelihood, at least in Florida law, that would still be treated as real property, but is that determinative? Again, we don't have an answer on that right now. I suspect we'll find out soon enough. Shifting over to the partnership area, there are a couple of things. I'm not going to cover them all, but let me first of all talk about carried interest. Let's assume that Jane, sitting at the end of the table down there, has a piece of property that's ripe for development. Steve Looney, everybody knows he's got a pocket full of money, and he's going to put his money into the development. But we're missing something. We're missing somebody who knows how to make all this work. This property we want to develop into a commercial rental property, let's say. Well, Ed, sitting next to Steve, despite his youthful appearance, has a world of experience in getting all the entitlements to get a project like this done. He knows how to supervise the construction. He knows how to do the rent-up, and he's an invaluable piece of this. So basically, Jane's going to put her property into, let's say, an LLC, taxed as a partnership, and Steve's going to put his money in there, and Ed, we're going to carve out and give him a 10% profits interest. He's not going to put any capital in there. He's going to put in sweat equity. Well, for years, this has been a hot button item as to what happens to Ed. Do we tax him when he gets that? How do you value that? Well, in 1993, the Internal Revenue Service came out with a revenue procedure which basically said, okay, here's what we'll do. If, when this property goes in there and Ed gets this interest, if you turn around the next day and you sold all that property, if all the money from the proceeds would go to Jane and Steve and Ed would get nothing, his interest is going to be valued at zero. It's a liquidation value approach, okay? If, on the other hand, you've undervalued that property, and Ed, if you sold it for true fair market value, would walk away with something, then he's got a capital interest, and we're going to tax him right now on that, unless the interest is not vested, in which case you just simply defer the incidence of taxation. Well, the new act has made a change in this area, but what I just covered with you does not change. What changes is, all right, Ed is now in place and he's got a 10% interest in this. What's the character of his share of the income coming out of this? Now, this has been a really controversial area. The major news publications have been talking about this for years. Most of the time, most of the abuses have been in the hedge fund and private equity fund area. They bring in a fund manager, they give them a profits interest. They call it a carried interest. And that's a major piece or major component of the compensation of that fund manager. But let's say that all of the assets in that fund are basically capital assets, stocks and securities. And when they turn over, that generates capital gain. Well, guess what? Ed, as the fund manager, instead of getting taxed at ordinary rates where you and I, if we're working for a business and we're getting compensated, we pay tax at ordinary rates. Not Ed. Ed's sitting over there clipping, not coupons, but he's basically getting all of his income in the form of long-term capital gains. Too much of a good thing. All right, so a lot of proposals floated on this, how to deal with it. And basically what we got is reform light. They did do something about it. They didn't do much about it. But the basic rule now under the new act for carried interest is that any income that would be allocated to Ed in my example that it would be treated as long-term capital gains. If the assets that gave rise to that long-term capital gain were held for 3 years or less, it's going to be treated as short-term capital gain, which, by the way, is taxed at the same rates as ordinary income. If the assets were held over 3 years, he's still going to get long-term capital gains. So it's an improvement. It's not really dealing with the root problem, but it is a change that you need to be aware of. And by the way, most of those changes are effective only for partnerships and LLCs taxed as partnerships that basically are involved in portfolio investments. But that portfolio investments, by the way, includes rental real property. Be aware of that. One exception is if you have a partner that's getting the profits interest and that partner is a corporation, it won't apply. Well, query, what about an S corporation? That's a corporation. Corporation under state law. Under the code, it's treated as a corporation for all purposes except as otherwise provided in subchapter S. Suppose we plug an S corporation in there to blunt the effect of this. Well, that's an unanswered question, but I'd say the way the statute is drafted right now, I can make a pretty convincing argument that that ought to fit within the exception. Another change, and this is, I think, a very good change. In a partnership, if you have a transfer, a sale or exchange of a partnership interest that's taxable, and not just one, let's say any combination of sales or exchanges of partnership interest that in the aggregate equal or exceed 50% of partnership capital interest and 50% of partnership profits interest, that partnership is deemed to have terminated on the date that you hit that threshold within a 12-month period. And that's a rolling 12-month period. It's not working off a calendar year. There was a reason for that provision many, many years ago. Subchapter K has been modified multiple times. The reason for it has long since passed. This has just been a trap for the unwary. That was repealed, effective for any transfers after 12/31/17. And by the way, the carried interest change, unlike a lot of the changes that we've been talking about, is permanent. And this one, I believe, is permanent also. I'm going to skip the mandatory basis adjustment, and I point out that one of the benefits in a partnership is if you have a partnership, you've got a share of losses. You can only claim those losses to the extent you've got tax basis in your partnership interest. If you work that partnership basis down in your partnership interest to zero through pass-throughs of losses or distributions or a combination thereof, any losses in excess of that would basically be warehoused for you until you've done something to replenish that basis. Well, there was one exception for that that's important, and that is charitable contributions. Congress basically felt that they still would allow these charitable contributions to come through, even though you didn't have any tax basis in your interest. That, unfortunately, for those of you who are charitably inclined, has been repealed. So that any pass-through of charitable contribution deductions will also be subject to the basis limitation rules. Finally, if you haven't heard me say anything else, and this is not part of the new act, but we just wanted to bring this to your attention. We now have the new partnership audit rules in effect. This was a product of the Bipartisan Budget Act of 2015, and it has dramatically changed the way a partnership or an LLC taxed as a partnership will interrelate with the Internal Revenue Service. One of the things that happens now, we used to have a tax matters partner who had some authority to deal with the IRS, but all the other partners could be, if they had any significant interest in the partnership, they could participate in an audit and a settlement with the IRS, and then the IRS would have to pursue the individual partners to collect the taxes. All that is by the boards. For any taxable year, beginning in 2018, we have the new partnership audit rules. Number one, in a change, we have what is called now a partnership representative. I call him a partnership czar, a tax czar, because that person has the unilateral right to enter into any settlement agreement with the IRS that he, she, or it chooses. It can extend the statute of limitations. They can do any number of things. And the service is entitled to rely entirely on the authority of that person. Number two, And the general rule under these new partnership audit rules is if the IRS audits a partnership and determines that there's been an underreporting of income, it computes a tax at maximum marginal rates, although you can prove to them that it should be less, and imposes the tax on the partnership, not on the partners. This is a pass-through entity. And we've always taxed the partners, and they pay tax at the individual level. The IRS can now assess it against the partnership and collect it from the partnership. Now, that changes the whole game, okay? And there is an election that you can push it out, but you have to make sure that the partnership representative makes that election on a timely basis. Suppose, we're talking about an audit of the 2018 year, and this is audited in 2020. And the composition of our partnership has changed. So the partners who are stuck there in 2020 have to pay the tax relates back to 2018. Is that fair? Does that make sense? Well, the answer is no. And what you need to do is you need to have all of your partnership agreements, all of your LLC operating agreements modified as quickly as possible to include provisions to deal with these problems. Number one, you want restrictions imposed on this partnership tax czar that he, she, or it cannot enter into settlement agreements with the IRS without the consent of partners holding at least the majority, maybe unanimous consent. We want to rein that person in. Does that limit the IRS? No. But by golly, if that partnership representative does it, he's going to get sued. So that's your control over that mechanism. Number two, you want to have the partners informed on a regular basis of an audit and the progress of that audit. You want the right to approve any settlement agreement that's entered into. The partnership representative also can determine whether to take this to court or not. You want to be able to control that. There are lots of things that you have to think about. And suppose we've had a change of partners. Who's going to bear the burden of that tax? We need something to claw this back. If somebody has basically bailed out, cashed out, and is long gone, and you want to stick the remaining partners with the tax liability.
And Charlie, I think that's an extremely important part of the partnership audit provisions is the need to change your partnership for indemnity, I guess, from partners who have departed if the tax liability relates to the years in which they were partners.
And also, if you're the unlucky person who is the partnership representative, you want to be indemnified because you're taking on a heck of a risk and you want to think about taking that position. And you build that in to these provisions as well. We've given this a lot of thought. We've devised some language, but it isn't a one-size-fits-all situation. But be aware of that. If you're in a partnership, if you're in an LLC taxed as a partnership, you really should not postpone dealing with this problem. You want to get this thing modified so that you prepared yourself for this new partnership audit regime. And with that, I'll turn it back over to, I guess, Jane.
Okay. So I'm going to close today, as well as having the first section with the section on tax-exempt organizations that appears there towards the end of your materials. And I'll start by just talking for a minute about changes for donors that are going to impact tax-exempt organizations. So these are changes that we talked about in the individual area, but they will impact exempt organizations. For example, consider the impact of the change in standard deduction. It's been estimated that there will be 37 million itemizers in 2017 that include a charitable deduction on their tax return, and that number will drop from 37 million to 16 million in 2018. So the question, and the nonprofit sector has been very concerned about the impact of this change on charitable giving. And so we'll just wait and see. The contra view is that, with the lower tax rates, everyone will have more money, they'll give more to charity. So we'll see. We already talked about the contribution deduction limitation is increased from the 50% AGI limitation to 60% for cash contributions to public charities, and the athletic seating rights changes. So these that changes on the individual level that will impact exempt organizations. But changes specifically to the exempt organizations, one is that, so tax-exempt organizations that normally don't pay tax on their income, they are required to pay tax if they have an unrelated trade or business that generates taxable income. So in the past, if a tax-exempt organization had 2 or 3 different unrelated trades or businesses that were generating taxable gain, income, or loss, they could combine all those together and report a net number, or many of them did. Now the change in the act is that each trade or business has to be treated separately. So a tax-exempt organization may have income from one business that's taxable and may have a loss from another unrelated business that they cannot offset against the taxable portion. And in this regard, on these separate trades or business and separate baskets or silos, consider also that the corporate tax rate, the change in the corporate tax rate has eliminated the graduated tax rates. So if a tax-exempt organization had a small trade or business that didn't generate too much income, they would have been subject to the 15% corporate tax rate, but now they'll be up at the 20% corporate tax rate. So this could have a pretty significant impact on some tax-exempt organizations. There's in the old law, there was some ability for a donor to a tax-exempt organization to say, well, I've gotten my required written acknowledgement of my large contribution, anything in excess of $250, by virtue of the fact that it's reported on the exempt organization's Form 990. This was creating a number of problems, and so that provision in the law has been removed, and now any donor to a tax-exempt organization of more than $250 or more that wants to deduct their contribution has to have a written acknowledgement from the donee organization. Another change is an excise tax now will be imposed on large endowments at private schools. This will be a kind of a limited application, of course. It's because it would have to be quite a large endowment for schools that have at least 500 students, at least 50% of them are located in the U.S. Combining all related organizations together, the tax is 1.4% of the net investment income of the endowment. So not charitable used assets, but just of the endowment. And as an example, Harvard has a $2.5 billion endowment. And there's been a calculation that at its 2017 earnings, their excise tax would be in the neighborhood of $43 million. So we'll see. There's been some in the news complaints about these large endowments held by the private schools who object strenuously to the new excise tax. And finally, a change in executive compensation. So tax-exempt organizations that pay any of their top highest paid employees more than $1 million will be subject to an excise tax. It matches the corporate tax rate, so 21%. And it excludes medical professionals, so all the large hospital systems that may have many physicians over that limit, medical professionals are excluded, but everybody else over $1 million, the exempt organization itself pays the tax, not the employee. And there's a lot coming up in the news about this now. 78 head football coaches make more than $1 million. 58 private university presidents make over $1 million, with Wake Forest leading the pack at $4 million, which is an $840,000 excise tax. Will have quite an impact on compensation planning at these organizations. And one of the hospital systems did pay its CEO $51 million in 2016, which would have resulted in a $10.7 million excise tax. So we'll look for this significant change for executive compensation for tax-exempt organizations to have quite an impact on their compensation planning. And just briefly, some proposals that were not adopted for any that follow any of these proposals through the exempt org world. Private foundations continue with their same investment excise tax rates of generally 2%, which can be reduced to 1%. A flat rate was not adopted. The Johnson Amendment repeal was not adopted, which means that churches and other charitable organizations still may not support or oppose political campaigns for office. And also there was a proposal to allow tax-exempt organizations to own businesses that were philanthropic, even though for-profit. Like, for example, the Newman's own business that was not adopted, so the regular excess business holdings rules continue to apply for private foundations.
Okay, well, thank you very
Steve,
much.
before we close,
Yeah.
one quick thing. For those of you in the agricultural area,
You want to hit the co-op, okay.
well, just mention that
All right.
pages 44 through 46 of the outline deal with some changes uniquely affecting agriculture, some of them very beneficial, the write-off of machinery and equipment and so forth. But one last-minute change that came in well past midnight just before this thing went through involving agricultural co-ops. It's been the subject of numerous articles, Wall Street Journal, New York Times, others. An unintended consequence that apparently there's an effort immediately to fix this problem. Whether it can be fixed or not is not determined at this point in time. But basically, if you're selling to a co-op, you get a deduction for, in effect, 20% of the gross sales price.
Right, this is under 199A, just the QBI deduction, but it applies to gross income versus qualified business income, and there's no wage and capital limitations.
That's right. And it went far beyond what I think the original writer of this provision intended, and we'll see what happens on that.
Although Dean Mead will be converting to a co-op. Thank you, everybody. We will be taking a break. I also should remind you, if any of you want a copy of the PowerPoints, just contact us. We're happy to send those to you. So Lauren Detzel will be up here at 10:30 with her group to talk about changes made to the estate planning area. Thank you very much.